right, everyone. Well, thank you for joining us for December's webinar. Um, this month, with it being Christmas coming up in a couple weeks, it's a season for giving, and so we're going to cover some ideas on giving to your favorite charity, as well as family, and then also some other ideas that may be off your radar, but are something to consider if it is relevant to you. So with that, we'll get started. And legal disclaimer, we're presenting this information. We make every effort to make it as accurate as we can. And if you would like to use any of this information or any of our slides, feel free to, but just let us know ahead of time. Thank you. So today's agenda: why estate planning is important to Kenny and Kenny, estate planning basics and our focus, when you pay estate tax. That's something that not everyone knows, so we'll go over that in this webinar, and why it's important to plan now. So these are best practices, and there might be some other strategies out there, but we feel like these are probably the most relevant and ones that, if you're going to do any estate and gifting planning, that you should definitely have on your radar. So with that, a little more about us. We're passionate about helping our clients build estates. We've got clients at all stages. Some of this may apply to you. Some of it may apply to some of your parents or other loved ones. And so we're always looking to advise clients on minimizing tax. And to that vein, we're presenting this webinar today. So some of the estate planning basics. What'll happen to your property upon death? That's what you take care of in an estate plan. Look at after the financial well-being of your family when you're gone. Today, we're going to look at how to eliminate or minimize estate taxes. And, you'll see when estate tax is payable, that's when it comes into play. And to minimize estate taxes, if that is relevant to you or your family, gifting can be a way to eliminate that estate tax. So it's important to start early. So a little more about the process of eliminating or minimizing estate taxes. You determine if your estate is going to be subject to estate taxes or inheritance tax. If your estate is subject to taxes, what estate planning strategies would help to reduce that amount? And should you begin a gift or gifting program? Generally, if estate tax is relevant, starting a gifting plan early is the best practice. And if you have stocks, bonds, retirement accounts, 401ks, some of those may be a good source of charitable contributions, and we'll get into a little bit more of that in a bit. And finally, we'll also talk about when you're required to file a gift tax return. So with that, so when do you pay estate tax? And so we'll go starting on the left. Basically, if the gross estate is over 13.61 million, the portion over and above that is subject to estate tax. Another thing to keep in mind is there's no tax between, no tax to a spouse. The estate tax form that's required when you do have a taxable estate, again, one that has assets in excess of 13.61 million, is Form 706. And the estate tax rates run from 18% to 40%. And again, kicks in at 13 point, actually, this is 13 point, actually the 40%, I'm sorry, the 40% rate kicks in at 13.92 million. The trust tax return is Form 1041, and those rates range from 10% to 37%. 37% comes into play with when the income exceeds 14,450. So comparing that to 1040 rates, which range from 10% to 37% as well. However, the 37% comes in not until the income is at 578,126 for married filing joint. So you can see that's a huge difference. So if you don't have a trust that has taxable income, you may not realize that the tax rates are substantially higher in a trust. And so now it may make sense for you to put assets into a trust. It may make sense for you to pay tax at that 37% tax rate, but generally it would require some planning, because if you're getting better rates in your 1040 and there's no strong reason why you would want to put it into a trust, you'd want to take advantage of those lower rates. So before you go out and set up the trust, it's a good idea for you to check in with your CPA and make sure it makes good financial sense, as well as legal sense. And so try to avoid a scenario where you go and set up these trusts, you fund them, and you come to us and we say, oh, by the way, now instead of paying 25%, you're paying 37% on that income. So in Illinois, which is our state, the estate is taxable over 4 million. Again, no tax to the spouse. The Illinois tax form is Illinois 700, and it's again required when assets exceed 4 million. The Illinois estate tax rates range from 0.8% to 16%. 16% comes into play at 10.04 million. So this is on top of the federal. So you may have an estate, if you're living in Illinois, that's not subject to federal tax, because federal tax doesn't come into play until 13.61 million. However, in Illinois, if it was over 4 million, you may have some Illinois tax to pay and a form to file. The Illinois trust form is Illinois 1041 for income generated by estates and trusts. And the Illinois trust rate is 4.95 flat rate plus 1.5% in Illinois replacement tax. Why you can't afford to wait? So let's look at some of the potential estate tax changes that are scheduled December 31st, 2025. So at December 31st, 2025, unless there's a tax law change, that exemption amount of 13.61 million expires and goes back to 5 million. So what that means is you're paying extra tax that you wouldn't currently be paying through the end of 2025. So what that looks like is, when you crunch the math, is pretty extraordinary. So if your gross estate is just under 14 million, the tax currently through the end of 2025 would be 345,800. After 2025, the tax would go up to 3,568,000. So an extra 3,222,200, or almost 1,000% increase. That's right. Now, I'm hopeful that there will be a tax law change and that exemption amount will stay where it's at, right around 14 million. But planning needs to be done based on the current tax law. So as we get closer to that expiration date in the second half, say, of 2025, if it looks like there's not going to be an estate tax change, you may want to check in with your estate planning attorney and have them update your plan. So plan so you don't have to pay twice. Essentially, estate tax is an inheritance tax. And the only way, if you have a taxable estate, to eliminate a taxable estate, aside from a tax law change, would be by gifting some of your assets prior to your death. So either that gifting happens to loved ones or it happens to charities that you love. So let's look at some ways for doing that. So the basic one is gifting up to 18,000. That's the 2024 per giftee with no tax or filing requirement exception. So what that looks like with a married filing joint couple, they can gift 36,000 without there being any requirement for a gift tax return. Now, let's say that they gifted 40,000. So there'd be 4,000 that would be reportable on a return. You're not actually paying gift tax. What you're doing is you're reducing your lifetime exception. So keep that in mind. And so again, that lifetime exception currently for 2024 is 13,610,000. So, and again, gifts to spouse, U.S. citizens, are generally excluded from federal gift tax reporting requirements and tax. One idea and strategy is to set up a life insurance trust. So what happens there is you take out a policy to benefit generally family members, and the taxpayer is essentially contributing the premium. That's the gift to the trust, and using that gift to purchase a life insurance policy that benefits their family members. It could also be a charity, but generally it's with family members. And that beneficiary has an opportunity to withdraw the funds. I've never seen it happen. And so those funds end up purchasing or paying the premium on that policy. When the taxpayer passes, the benefits of that death benefit go directly to the beneficiary without tax consequence. So that can be a very effective strategy when you have a taxable estate. Some other ideas would be when you've got privately held assets, like family business or a piece of property, generally you can gift a portion of that ownership in an entity. And since, well, in many cases, it's a minority ownership. And so the value of a minority ownership is less than what a controlling ownership is in a particular entity. So a valuation person can take discounts on that and generally reduce the amount of the gift. So that can be another effective way to transfer assets out of a taxable estate to the next generation. Another great idea when you've got a taxable estate is gifts to IRS approved charities. Those are not subject to gift tax. And one way to think about that is if there's a charity that you love, you've got assets that are more than enough to support your lifestyle, why not make those gifts to those charities now while you're alive, and you can see that benefit play out for that charity? Along those lines, if you've got substantial retirement accounts, you've got IRAs, when you take your required minimum distributions out of those retirement accounts, those trigger taxes. One idea is starting at 70 and a half, you can make a qualified charitable distribution, otherwise known as a QCD, to your favorite charity. And those distributions to the charity are not taxed. So it's not going to increase your taxable income. If you're on Medicare, it's not going to affect your premiums. And those can be really great ways to support a charity that you're really 100% behind, as well as also lower your retirement account balances. So your RMDs that you're required to take starting at 73 are reduced. So that can be a really effective strategy to deploy if it's relevant. Now, medical expenses that you're paying directly to a provider, those are not reportable. Education expenses directly to the institution, same goes there. One really interesting idea is funding a 529 plan for, say, a grandkid. You and your spouse can contribute up to 36,000 a year, and you're able to make a one-time gift, plans up to 5 years. So 180,000 currently into a 529 plan, and essentially probably fully fund a grandkid's education. Another interesting 529 strategy that's a little newer is when you have a 529 plan with funds that weren't used for the education. Let's say your grandkid got a scholarship and they don't need the 529 funds. Those unused 529 funds up to 35,000 can get changed over to a Roth IRA, which is a phenomenal retirement vehicle. So nice little benefit for your grandkid. Now, one thing that's important to keep in mind is that 529 plan would need to be open for 15 years. And so one good idea is maybe just start the account for your grandkid, and then you can always decide later what kind of funding you want. So those are some very common and relevant strategies. When you're working actively on an estate plan and a gifting plan when you've got a taxable estate. It's not for everyone. I mean, just think about that exemption limit. So you'd have to have assets of 14 million for, you to need a gifting strategy to lower that, or, if there's no tax law change. But generally, your team consists of an attorney, estate planning attorney, CPA, financial advisor, and insurance representative. Trusted business partners. So when you've got one of those privately held assets, would sometimes include partners, key employees, and third parties. Recipients of gifting programs are generally family, as we've mentioned, charities, friends. Sometimes people take care of their pets with their estate plans. Fiduciaries and would involve family, trusted advisors, financial institutions, and trust specialists. So the trustees or executors of estates and fiduciaries. If you've got a trust, you have to name someone who's going to be in control of that trust. A lot of times, individuals or taxpayers will name family members. So it's something you want to take some time and make sure you pick the right person. You may have also a trusted advisor, attorney, CPA, and in some cases, individuals or taxpayers will name a financial institution, depending on the size of the estate. If the estate is taxable, I think it's probably worth considering a financial institution, or at least have a financial institution as a backup to a family member or a trusted advisor. And along those lines, there's also a trust specialist. So, well, that brings us to the conclusion. One charitable idea. This is a not-for-profit Center for Independence. My son goes there. It's a really awesome school for kids with disabilities. And if you're so inclined, check them out. They're at www.cfimove.org. And I appreciate you checking in with us and joining us for the webinar. And I hope you have a very Merry Christmas and a Happy New Year.